2019 has been a tough year for the economy and most investors. It is also a year of contrast. On one hand, economy has been weaker as reflected by 4.5% GDP growth in the September quarter, and investors are staring at weak returns on their investments across various asset classes. Still, on the other hand, Sensex is at all-time high. What has led to this kind of performance, and more importantly, what is the way forward for year 2020? First, stock market is not so much interested in absolute numbers. It is looking at trends and direction. Though we are going through a very rough patch on economy, I am sure this will change for the better. Though overall India's economic growth is muted, some sectors are doing well, like domestic air passenger traffic grew 11% and diesel consumption grew 9% in November 2019. The critical question is whether the economy has bottomed out and we will see improvement in the coming quarters, or we will continue to struggle at 5% growth levels for many quarters. Markets are implying that things will get better from here. From a low base in 2019, marginal improvement in demand, lower credit cost and lower tax rates would result in decent earnings growth for year 2020. But for the market to sustain, we need something more on both economy and fund flows. It is evident that government is keen to take various initiatives to revive economic growth. So the market is keenly looking forward to budget proposals, including a cut in personal taxes to revive demand. Government has to accelerate spending on infrastructure, that is roads, railways and power sectors, to kickstart investment-led growth. Similarly, divestment should pick up momentum, and early completion of stake sale in BPCL and Concord would set the stage for next phase of bold reforms. Stock markets are about the future, not today. When someone is investing in the equity of any company, the most crucial question is what are the prospects of that particular company, not what the company has delivered in the current quarter or previous quarter. Of course, the past track record is important, but future outlook in terms of profit growth is the most critical driver of stock prices. While it is true that 2019 has been weak for the country and corporate India, the market is betting that things would get better from year 2020 onwards for the economy and corporates. It is also interesting to note that while the GDP growth was decelerating and hit a low of 4% for the quarter ending December 2003, BSE Sensex has doubled in the calendar year 2003 from 3,000 levels to 6,000 levels. So this clearly highlights that markets are generally ahead of economy. While the domestic investors are worried about the economy and wondering why stock prices are going up, foreign investors are behaving very differently. FI flows into India have touched 13 billion in the current year. So global markets are volatile and likely to remain so going forward also. Two major events to watch out are US elections and how US-China trade talks progress. In a normal course, India is bound to attract steady inflows from FIs, considering the higher growth rates and attractiveness of India over many other economies. But our dependence on imported oil and electronics makes us vulnerable to global events. The market has delivered polarized returns in 2019 due to concerns on governance and economy. Companies with high quality businesses and governance levels were rewarded and are trading at significant premium to the broader market. But in year 2020, as economy picks up, the next phase of the rally in the stock market is likely to be more broad-based within large caps, mid and small caps. So we like multi-cap funds. We are positive on pharma, chemicals and utilities as growth outlook and valuations are reasonable. We are underweight on FMCG and auto sectors as there are concerns on growth rates and valuations are demanding. Thank you. Wish you all a happy, healthy and prosperous new year.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.